Amazing, right? That's exactly where things start to get dangerous. There's a product right now pulling in a lot of investors, promising returns that looks almost too good to ignore. It's called Strategies STRC, and honestly, it worries me. Today, I'm breaking down what's really happening behind it, the risks nobody's talking about, and how it's all tied to Bitcoin. So, Strategy. Strategy is the company that was launched by Michael Saylor. He's still a major shareholder in the company. Before it was called MicroStrategy, the goal of the company is simple: to accumulate as much BTC as possible. And so far, it's worked really well. They've accumulated around $58 billion worth of Bitcoin, which is massive. So yeah, they're way ahead of the other publicly traded companies. What they've done is huge. And Michael Saylor was one of the first to truly believe in this trend. So he basically introduced this idea of a company that raises money to buy crypto. For a large part of Strategy's existence, the way they raised money was pretty straightforward. They issued new shares, sold them, and used that cash to buy BTC. And because the stock was trading at a premium compared to the actual Bitcoin they held, it made sense. There's always been a premium, a small premium or large premium before. If you look at it right now, the MNAV ratio, which measures the company's valuation compared to the value of the crypto it actually holds, we're currently around 1.17. That means there's a 17% premium over the Bitcoin they hold. So in that situation, issuing new shares and selling them and buying BTC still makes sense. It's still profitable, but it's less attractive. It's less attractive than when the MNAV was at 2x or 3x, which did happen for a while. So strategists start looking for other ways to raise money to keep buying BTC. With the traditional method, issuing new shares, there wasn't really any risk for them. Then any risk at all, because there were no liquidation risk, no dividends to pay. It's basically the cleanest way to do it. And that's how they managed to buy tens of billions of dollars worth of BTC. But then they had to explore other options, other techniques. They launched several financial products: STRF, STRK, STRD, and the whole range of products. And the idea was simple. You give money to Strategy, and in return, they offer you a fixed yield. For example, STRD offered around 10% fixed, STRK around 8%, STRF around 10% as well, each with slightly different conditions depending on the product. With these products, they raised around $3 billion. But then they realized that fixed dividends might not be sustainable in the long run. And yeah, I agree with that. So they shifted toward variable dividends, a variable yield. That's how STRC was launched. So what is STRC? It's basically a kind of share that's supposed to be worth around $100. Strategy says this token is worth $100, and they try to keep it around that level. When the price drops below $100, like right now it's around $99, and in the past it even dropped to $95, they have a mechanism to push it back up. And that mechanism is simple. They increase the yield. That's how it started. They started around 10%, and now it's around 11%, 11.5%. And that's how we got to the 11.5% yield on the STRC. So from an investor's point of view, you can look at it at a yield-generating product, almost like a saving product that gives you returns. This is way riskier than pretty much anything they're presenting it as, because I'm going to explain why. And there's also the strategy behind it, and I'm going to present everything and the risk really around this product. Let's start with the core issue. You have absolutely no guarantee that this thing stays at $100, not in yield, not in value. So yeah, Strategy has zero obligation to buy back your tokens when you want to sell, and they won't buy it back. So if you decided to exit, you're selling at market price. That's it. That's your first major risk. So the $100 can turn into $50 maybe. Then you've got the dividends. You've probably seen the numbers being thrown around 11.5%. But when you actually dig into the official documents, the real one from Strategy, you get the full picture. There's a 61-page document detailing all the risk and conditions. And in there, it clearly says that the dividends can be stopped at any time. Whenever the boards decide it's necessary, they can just shut them off. So there's no guarantee those dividends keep coming. And the day they stop, if that happens, you can be almost certain the token won't stay near $100. That's obvious. A token that doesn't generate yield anymore, it loses most of its appeal. they'll just trade at whatever the market decides it's worth. And maybe there's still some residual value, maybe a lower yield expectation. I don't know, but you get the idea. Now let's step back and look at why strategy is doing this and what the bigger vision is. It's actually pretty simple. It's to raise as much money as possible to buy BTC. From their perspective, there's very little risk. And honestly, it's a great deal for them. If things go well, they keep accumulating BTC. If things don't go well, they can just, if they can't sustain the dividends, they just stop them. End of the story. No structural risk that brings down the company. They can cut the obligation at any time and move on. So for strategy, it's a win-win structure. And if Bitcoins keep going up over time, which a lot of people believe, and I'm part of that camp long term, then the model can work. But that doesn't mean it's smooth. There can be years where BTC goes down or crashes hard, and that's part of the game. And Michael Saylor himself explained the logic in interviews. Their assumption, or his assumption, is that Bitcoin grows around 30% per year on average. So from their point of view, giving 10 to 15% to investors who provide capital to buy BTC is totally acceptable. They keep the rest of the yield. That's their model. BTC going up 30%, give up 10 to 50% in yield. As long as BTC grows faster than the yield they promise, around 11% for STRC, they can sustain it. That's why at the current scale, it's still manageable for them, even if they have to sell BTC, for example, to pay the yield. Right now, they have roughly $6 billion in this product versus around $60 billion in BTC. So it's about 10%. And that's still relatively contained. But this is where you need to pay attention, that ratio. The higher it goes, the more kind of leverage strategy is effectively taken on. At some point, the dividend burden becomes heavier and harder to sustain. And that's when things can start getting complicated. So the key takeaway is simple. The main risk is not on strategy side. It's on the people buying these tokens. And honestly, the way this has been marketed at times is misleading. It's often compared to something like high-yield saving accounts or almost like a boosted saving product or even a bank account. So that's not what it is at all. This is a high-risk financial product. I personally wouldn't recommend it. Again, I'm very bullish on Bitcoin long term, but I'd much rather just buy Bitcoin directly than go through something like this or go through the MicroStrategy stock. With this kind of product, you're exposing yourself to mechanisms that can break, and when they do, it usually doesn't end well. It reminds me of the algorithmic stablecoins that failed. I'll say it straight, people might criticize me for this, but it reminds me of Terra Luna, the collapse of the UST. Yeah, the yield isn't fixed here, it's a variable, and that's exactly what I'm saying. There's no real risk for strategy at that level. The risk is on the token holders or the shareholders. Once again, the day this thing drops, whatever, in fact, they change the yield to 5% to 3%, then it's going to crash. It's logical, and it's very concerning. And it brings back memories of algorithmic stablecoins, like I said. And look, I'm the first one chasing yield in DeFi. I dig, I investigate, I look at all the options. What's the best yield? What strategies make sense? There are plenty of opportunities in DeFi, but the yield has to be clear, transparent, and the risk has to be under control. There's no way I'm accepting even a 10% yield if the capital itself or the collateral, the base token can drop heavily. It makes zero sense to chase 11% yield if there's a real chance your entire token depeg and go to zero. So yeah, personally, I'd rather go for more stable yield. Recently, I talked about I found some yield of 8% or 10% on stablecoin, and I prefer this kind of yield that I know where the yields come from than something like this, like STRC. So yeah, that's my take. I really wanted to zoom in on strategy because someone asked me about it, and yeah, I figured it was the right time to break it down properly. I've already shared my opinion before, but not in details like in this video. So now, to be fair on the company itself, I have a huge respect for what they've done for strategy. I don't think they're going to be forced to dump their whole BTC stash overnight or anything like that. But personally, I'd much rather just invest directly in Bitcoin. I'd rather buy BTC than buy strategy stock. And if I want leverage, there are plenty of ways to get leverage without going through strategy. There's just something about this approach that doesn't sit right with me. And all this financial engineering just to raise funds and buy BTC, I'm not a big fan of that. If I want exposure to BTC, I'll go straight to BTC, like I said. All right, that's what I wanted to share today. I'll see you on Monday for a regular news update. Today was more of deep dive on a specific topic. All right, take care. Bye-bye.